Okay, welcome everyone. I know I might be a different face. I'm Sam. You may have seen me over the past few weeks doing earnings releases. While Paul's traveling on vacation, I'm covering. So we have a big one today. The number 10 most owned stock by retail investors, Palantir, has just reported. So I'm going to walk through their earnings report, show you what I would look for as an analyst, and then from there, we'll walk through our 8 pillars, our metrics, and run the stock analyzer. Okay, guys. So as we can see right here, Palantir just reported. It's just after 4 o'clock. They are already up 6 to 7% after hours. So we're going to go in, check out the actual report, and see why that is. So as we can see, we have a pretty decent beat on revenue, though. So revenue came in for Q4 at $1.4 billion or so. And even more important, this is probably why the stock is jumping up 7%. Earnings beat by 19% compared to analyst expectations. Okay, guys, so I have the actual report pulled up. They just reported Q4 and fiscal year, so we're going to check that out. Before we go into that, I think there's a lot of talk around Palantir, and I've talked with people in the community about it because I feel like not a lot of people understand the business. So I'm going to try to break it down for you simply. So companies and governments, because that's their 2 primary revenue sources. So you have government revenue and then you have commercial revenue. Their 2 main products are Gotham and Foundry. You know, they're just designed a little bit differently to fit the different needs that those 2 organizations and groups have. They basically take all of the data an organization collects. You know, for example, from a government perspective, maybe it's internet searches, it's everything that's someone's spending, all of that different information. From a corporate side, all the sales reports that are coming in, all the supply and demand, and they aggregate all of that data. You know, they take all of that and they put it all into one organized form, and they act as the backbone of the entire system. That gives them what we would call a moat in the fact that they have a high switching cost. Once they're integrated into a system, there's a very high cost to actually switching off of Palantir system. So that's why a lot of people, a lot of investors have been heavily bought into Palantir since it IPO'd a few years back. Okay, so on that note, let's look at the key metrics that they report on. One of the big ones I want to check out and I want to tell you about, one of the big metrics I want to check out in the actual report is the Rule of 40. Alex Karp talks about this all the time. It's popular for software as a service businesses, so SaaS businesses, and it basically means their margins plus the growth that they're seeing should be above 40. Palantir is famous for having over 100% and boasting that quarter over quarter. We can see right here, their Rule of 40 score in Q4 came in at 127%. So guys, that's very impressive. On top of that, that's the type of thing that drives, you can see right here, revenue grew 93% year over year, 22% quarter over quarter. Guys, I mean, this is incredible. So this business is growing at a rapid rate. Something interesting to remember, and we'll see once we go into our software, is that everybody perceives Palantir to be this huge business, right? Because it's a $350, $400 billion behemoth tech company. That being said, Palantir's revenue is actually just under $4 billion trailing 12 months before this quarter. So it's actually not a large business. So the growth of this scale shouldn't come as shocking necessarily because they're actually still a small business growing rapidly, integrating into the commercial side of the business. So next up, you can see commercial revenue, like I said. So this is the part in 2022 when we saw Palantir come crashing down. It's actually the time where a lot of community members in our software got interested. So I've talked with them about that, what they were seeing at the time. But it was around that time that they said, okay, we're going to integrate into commercial. That became the new growth engine. You know, government was slow. They would get a lot of strong contracts, but it was not what commercial had to offer. So you can see commercial revenue up 137% year over year versus government revenue up 66%. So government revenue is still really strong, but commercial is what's going to drive that insane, 90% top line growth that they are projecting over coming years. Looking a little further, we can see overall their total revenue grew 70%. So we saw US revenue grow 93% with the commercial integration. Overall worldwide revenue came in at 70%. So on that note, let's go ahead and switch over to the fiscal year. Let's see what we're talking about. So here's one big number. You've heard Paul talk about it all the time. You've heard myself talk about it all the time. Mo, Dalton, the entire team. Free cash flow. So their free cash flow came in at $2.27 billion. Back in the day, people would bring up the fact that Palantir was just eking out earnings beats quarter after quarter, right? They'd beat by a penny or even less sometimes. And people were saying that maybe they're, maneuvering stuff around the financials to be able to beat. But the good thing was that at all those times, free cash flow was significantly stronger. And we can see they just came in at over $2 billion in free cash flow. I believe trailing 12 months before this most recent report, it was $1.8 billion. So that's really impressive. What else would we like to see here? Okay, so we can see that their operating income was $2.25 billion. So for those of you who don't know, free cash flow is operating cash flow from operations, less your capital expenditures. One of the great things about Palantir being a software business is that they don't have a heavy amount of CapEx. They're a capital light business. So that allows them to really reinvest that money in growth versus having to use it in maintenance to keep the business running. Okay, last thing I want to cover on the actual earnings report, we can see the margins right here. So these are going to be important when we go and talk about our stock analyzer tool. Because Palantir is a younger business and hasn't been public for very long, we want to make sure we note these margins. So we can see that operating income was a 50% margin, free cash flow 51% margin. So just remember that because their margins are continuing to increase as they move more commercial. Okay, guys, now I have our metrics page pulled up. Let's kind of take a look at Palantir's actual financials. So the first thing I want to talk about in terms of Palantir's financials and metrics is growth. That's the biggest piece of this story. For a company to trade at 200 times free cash flow and 340 times earnings, which, guys, we're going to talk more about the valuation of the business and how maybe they can potentially grow into it, how it could be overpriced today. You know, it's all about the assumptions that you make as the analyst looking into Palantir. But in order to trade at prices like this and it to be even somewhat reasonable, you have to see significant growth. The good news is we just read the report. They came in at 70% total revenue growth year over year. As we look out into the future, we want to figure out, will that 70% continue? Will it fall down to something which would still be exceptional, like 30 or 40% revenue growth, but that affects the valuation long term? So next thing, like I said, I mentioned to you guys, software businesses are capital light. What does that mean? They have very little debt. So you don't have to worry about Palantir, seeing their debt become overwhelming and going out of business. They have very little need for it because of the way that they operate. So strong cash flow growth, strong revenue growth, strong income growth. Now, one more thing I want to touch on before we leave this page is right here. Shares outstanding. We talk a lot about buybacks and dilution. And what's interesting is, as much as dilution can be painful as an investor, because that means that the percentage ownership that you've bought into the business for decreases as they, issue additional shares, it can be the right decision at times. So if Palantir is trading at, extremely high valuations, them diluting shareholders could be the best possible capital allocation choice because it allows them to get money at high prices to reinvest back in the business and grow for the future. Okay, guys. Now, one thing I want to touch on. I was listening to Alex Karp, who's Palantir's CEO, speak at the Davos conference. For those of you who don't know, Davos is a small town in Switzerland, and all of the great business leaders go there for the World Economic Forum each year. And when he was speaking and being interviewed by Larry Fink, who's BlackRock's CEO, he was talking about the strong demand for Palantir's product. He was talking about the fact that they have a very small sales force because the demand right now is significantly higher than what they can actually produce and then have their team go work on and integrate into these different government systems and different commercial systems. So what I want to walk you through is how I would think about the valuation from a high level perspective. And then we'll go in and use our stock analyzer tool to see if today's price sounds reasonable. So where I'd start is we just saw them come in at around $2 billion, right? So we saw them come in at around $2 billion in free cash flow. If we talk about the next 10 years and figuring out if the growth justifies today's price, we want to look at what free cash flow will be 10 years out. So let's say that we are looking at 2036. Today we're in 2026. We have a 10-year period. So let's assume Palantir is going to grow their free cash flow at 30% for 10 years. Now, guys, I haven't done incredible in-depth research into this company. Maybe you've done more. Maybe you can adjust these type of assumptions. That's why our stock analyzer tool is so useful for you to go in and actually be able to determine based on your expectations what the company's results are. But let's look at 30% growth. So that would take us, just quick math, I'm not going to go super in detail, that would take us to somewhere around $25 billion 10 years out. That's incredible. We're looking at over 10x growth in that 10-year period. If we apply 30 times earnings to it, the reason I say 30 times is that's usually my cap of how high I'll go, because 30 times earnings equates out to around a 3% earnings yield for the business. If we go 30 times earnings, that gets us to somewhere around a $750 billion market cap. Where are we at today? Somewhere around $375 billion before we saw this massive jump up. So what is that? That would be about a double over the course of 10 years. The rule of 72 for compound interest would tell us that a double in 10 years is just around 7%. So that would mean that if Palantir grows 30% a year, grows that bottom line or free cash flow 30% a year, you could expect around 7% returns doing the math. So that's why we want to go use our stock analyzer tool. I'm going to shift over to it because we want to take a look and figure out, using a range, what a fair price today would be to pay for Palantir. Okay, guys, let's go in and actually make our assumptions in stock analyzer. So I'm going to factor in the margins and growth I saw from the actual earnings report and what we've seen historically, and then kind of consider that as they become a larger business, we can't perpetuate out insanely massive growth. So top line, revenue growth. How much sales growth will they see? Well, like I said, during Davos, I heard Alex Karp talk about the fact that right now, demand is higher than the supply that they can give. So I wouldn't expect growth to slow right now, but in the long term, if you talk about diminishing returns and as they grow and scale, it's going to slow a bit. So top line, let's go on the highest side. And I want to be aggressive here. I want to see how Palantir looks based on a range of conservative to aggressive assumptions. So I'm going to go with 35% top line growth on the high end, 28% in the middle, and 21% on the low end. Now, guys, that seems really aggressive if you've watched past videos of Paul, Dalton, or myself. But the reality is Palantir, although they're a huge business market cap wise, they're not that large a business in terms of the actual revenue. So, that type of scale would take them from, being a $4 billion revenue company to something more like a $40, $50, $60 billion revenue company. Now, margins. We just saw around 50% free cash flow margins for this most recent quarter. So I'm probably going to work back from there. But like I said, get more conservative as we go to the lower end assumptions. So I'm going to start with 50%. I'm going to go with 45 and 40 on free cash flow. Now, profit margin has trailed free cash flow a bit historically. So what I'm going to try to do is factor in that there will be a bit of a gap long term, but maybe that'll equate out closer to that as we go on. So I want to start with around 28. Let's go up to 34 and 40%. Now, guys, like I said, I'm going aggressive assumptions here. I did tell you, though, typically 30 times earnings when we're looking out for a 10-year period. Because remember, the earnings multiple we're applying here is at the end of 10 years. So it won't be that Palantir has, 30 to 40% growth ahead of them. It will be that's what we've seen in the past. So we want to factor that in. I'm going to go with 30 times free cash flow and earnings. I'm going to go in the middle end, 27, and the low end, 24. Like I said, this is a business that's growing at really high rates. I'm sure you've heard Peter Lynch talk about the PEG, or price to earnings growth ratio, which can be added as a different kind of screening metric on top of PE to kind of show you whether or not the PE they're trading at may be justified. So Palantir, we're going with 24, 27, and 30 times earnings. And I'm going to start with a 9% return across the board to get our fair value or intrinsic value estimate. Okay, guys, here's our results. So as you can see, we're going to focus on free cash flow for right now. I have about $106 in the middle, which would represent a little over a 5% return if these results that I just put in play out over the next 10 years. So remember, this is not a price target. I'm not telling you that Palantir is going to fall to $110. Maybe they're going to grow significantly, and maybe it is a little overvalued today, but that price and value will end up equating out as the value grows at a significantly higher rate. So you can see on the high end, though, if they're able to perform at this level right here, you can expect around a 13% return. Why is this such a wide range? Because there's a wide range of outcomes that can happen when you're looking out 10 years into the future for a tech-heavy company that's growing rapidly. You can see on the low end, you'd get a negative return. That's because you're seeing 90% growth in the US and 70% growth overall right now. So 21% would probably come below what the market is pricing in as we look at it today. Now, if I were building in a margin of safety on Palantir, I'd probably do what I call a heads I win, tails I don't lose much approach. That term was coined by Monish Pabrai in my personal favorite investing book, The Dondo Investor, where it talks about you want to be the worst case when you make an investment to be that you still do well, you still do okay, you don't lose money. But the best case to be that you make exceptional returns. So maybe I would come in here and I'd build in maybe a 10% return on the low end and something like a 15 to 17% return on the high end. So if you're using Stock Analyzer on the software after you watch this video, make sure you build in that margin of safety. Okay, I hope that helped. We gave the entire earnings coverage. We talked about the actual financials of Palantir and the Stock Analyzer. Like I said, go do in-depth research on this company, right? Go figure out how you can make the smartest and best assumptions about what's going to happen for the next 3, 5, 10 years, and make sure that you understand the story of Palantir and their business, like I explained earlier, and have the numbers behind it to make sense of why it's a good investment today if you're looking to buy. Now, market's obviously reacting. It's up. Let's see if that holds or if it, maybe falls back a bit as we move into the day tomorrow. But I want to thank you guys for watching, and I want to make sure that if you enjoyed this content and you're interested, we will be in the community talking about Palantir. I've already talked about it as the day went on today with multiple members about, what they're maybe looking for in the results. So if you want to, we do a $7 7-day trial. Go check it out. Go join. Come talk with me in the community. I send 40 to 50 messages a day in there. Thank you for your time, and I appreciate you guys watching.